Hi all, welcome to my YouTube channel Banking Regulation Simplified. In this channel, you will understand the latest trends of banking regulation, understand in-depth concepts of banking regulation, and also you can use this YouTube channel to catapult your career in the world of banking regulations. Good luck. Hi all, welcome to another video in our channel Banking Regulation Simplified. Today's video is probably important if you are serious about a career in banking regulations. Yes, we are going to have an overview of Basel IV. This will be a high-level overview. The detailed study of Basel IV will be in the subsequent video, but I think it's more of a primer or for you to get into thick of things or probably under the skin of Basel IV regulations, because Basel IV is currently in following in some of the major economies like Singapore, Hong Kong, and will be shortly followed in other major economies like US, European Union, and UK. So this is the future of banking regulations, the latest version of Basel Accords, which will be in state and in vogue for the next 10-15 years. Just like how Basel III was in practice from 2010 till 2025, which is a span of about 15 years. So on the similar vein, Basel IV also will be in practice, let's say somewhere roughly from 2026 till 2040. Okay, so for all aspiring freshers or for all existing professionals in the banking regulations field, if you think you want to crack the code to start your career or to gain an entry into the highly desirable field of banking regulations, then probably your key to success is to understanding the Basel IV regulations or Basel IV Accords. So this video will probably bear a lot of significance from that aspect. So just in case if the slides are not clear, I shall attach a copy of the video slides towards the end of the video. Now let's get into this video. Okay, so it's finalization of the Basel III reforms, probably something which has been left untouched or unfinished during the 2010 period when Basel III was introduced. So industry calls it Basel III Endgame or Basel IV or probably Basel III Conclusion. But basically, it's an amalgamation of various BCBS papers which tries to address the chinks in the armor of the banking regulatory world or gaps through which banks will be in better position during adverse times. So when you are talking about addressing gaps or chinks in the armor, it means addressing a variety of issues or a gamut of issues which have been addressed through a slew of BCBS papers, which collectively is being called Basel III Endgame or Basel IV by the banking fraternity. Okay, so it was announced in December 2017 by BCBS. So implementation is phased in 2023 to 2028. Uh, it got delayed mainly due to the COVID-19, because COVID-19 was a huge body blow for the banking industry. Simultaneous default, simultaneous bank runs, simultaneous slow or grinding halt in the business. So at that time, they had to dig into their capital ratios to stave off the crisis and bounce back. So they pleaded for additional time, which was a correct request, and banks are right on their part. So this was duly acknowledged and granted by the banking fraternity or the respective regulators. Or else by now we should have been in a Basel IV regime. Thanks or probably no thanks to COVID-19. But in certain geographies like European Union and US, the implementation may go on still till early 2030s. Okay, what's the background? Why Basel IV is required? Why it is linked to Basel III in some ways? Okay, though Basel III improved the quality of capital by introducing an array of ratios like capital conservation buffer, countercyclical buffers, and GC buffers, but still banks held the upper hand or probably were able to navigate through the loopholes by systematically quoting their RWAs through the internal methods and thereby lowering the amount of capital required. And also, from a regulatory lens, for banks operating in the same geography, same and for the same set of customers or for same profile of customers, each banks were giving a different set of values of RWAs and capital. So this is kind of kind of confusing and highly contradicting, because you are operating in the same geography or the same booking location and the customer profile is same, meaning the risk parameters are same, but bank A probably is quoting a different RWA and bank B is quoting a different RWA, means they are able, one of the banks, either bank A or bank B, is able to get the better of things through rigging through the internal models. So this was a lever given by the regulators, so they can't take it back, and banks have also got acquainted to that lever, so they have to think around to fill the gap. Okay, so that is where they have come up with a slew of regulations in Basel IV. Okay, so in other words, restore credibility of RWAs and improve global consistency. So from a regulatory lens, the amount of RWA quoted for a particular geography or for a particular profile of customers will be more or less same for each banks which are reporting the same regulator, meaning all of them are on the same footing, and in times of crisis nobody will be impacted adversely because they will be having the same amount of risk parameters, risk levels, and same amount of capital set aside. Okay, so the key features of Basel IV, like I said, it is to ensure uniformity in the risk numbers quoted, calculated, and reported, and thereby ensuring the same amount of capital is set aside. So that is done through something known as output floor. This is the biggest change or the game changer under Basel IV. Just like how I was telling that leverage ratio is the biggest game changer under Basel III. So what exactly is output floor? Okay, so it pegs the capital requirements or the RWA calculation methodologies under the internal methods to the outputs under the standardized method. How this really works is, the output of a RWA under an internal model method by any bank is compared with the RWA output under the standardized method. Let's say the RWA output under the standardized method is $100 and the RWA value under the internal method is $50. Previously under the Basel III regime, banks were conveniently quoting $50. Let's assume a capital ratio buffer of 15% or 20%. If you are working or reporting under the standardized regime, $100 of RWA, your capital would be 20% of that, which will be $20. On the other hand, if you are quoting or reporting under internal methodology, your RWA would have been $50 and the capital set aside would be 20% of that, which would be $10. So you can see there is a 100% difference between the capital allocation between the standardized method at $20 and the capital allocation under the internal method at $10. So this kind of meant an unlevel playing field when you're still going to face the same types of risks in the same economy, or are subject to the same risks in the operating banking in the operating business models. Okay, so this anomaly needs to be addressed. That is where output floor came, meaning even if the output of RWA under the internal model is 50% or at $50 and the output of standardized method is at $100, what banks need to do is the output of RWA under the internal model cannot be less than 72.5% of the output under the standardized model, meaning if output under standardized model is at $100, the output under IRB model or the internal model must be raised to a bare minimum of 72.5% of the standard RWA model, which in other words is $72.5. So you see the difference. When earlier under the Basel III regime, a bank would have quoted $50 for RWA. Now they need to quote $72.5, which is a nearly 50% increase, and marginally less than the output under the standardized model. So meaning, even you are able to rig, you can't report it, meaning you need to peg your output of internal model to a 72.5% of the standardized model. So this brings things to a level playing field, and banks cannot leverage or highly rig the internal models to their own benefit. On the other hand, this brings uniformity of numbers from a regulatory lens or from a regulatory review point of view, and aside to that, the amount of capital set aside will be more or less same, and slowly down the future this will dissuade the dissuade banks from operating under the IRB model and would make them probably push them or force them to move to standardized models and disincentivize the adoption of internal models. So this is a game changer where things will slowly move towards uniformity and will push banks to adopt standardized methods across all geographies, across all jurisdictions. So meaning it will create a global playing field. Now let's move on. Okay. Next is credit risk reforms. Like I said, credit risk is one of the key components under Pillar 1 of Basel framework. So there are revisions both to the standardized method and the internal method. In this slide, we shall see the revisions to the standardized method alone. So standardized approach, more granular risk weights based on borrower type, collateral and external rating. Meaning earlier there were 5 buckets. Now the number of buckets under which are available for calculation of the standardized method has probably increased from 5 to 7. And the second is residential mortgages. So the risk weight is differentiated by loan to value ratios, meaning loan to value is a concept wherein when you're taking a mortgage loan, the amount of loan is pegged to the value of the property and is given as a ratio or a number. When the loan to value ratio is lower, meaning even in the event of a default, you can still sell off that mortgage and reclaim your dues and loans. On the other hand, if the loan to value ratio is high, in the event of a default, when you sell off the mortgages, the amount which can be realized would probably less or probably not meet your dues, which would include both your principal and accrued interest. Okay, so in the event of a higher LTV, the risk weight is kept higher, and on a lower LTV, the risk weight is kept lesser. And corporate exposures, one of the biggest asset classes for all banks, has been split between investment grade and non-rated. So now the revisions or the refinements under the IRB method, internal rating based method. Large corporates and banks can no longer follow the advanced IRB method, must either use the standardized or the foundation IRB method. Retail and SMEs are still allowed but subject to stricter floors. So this will reduce variability in risk weights across banks, meaning banks and corporates are the biggest customers of the asset classes for all banks. And mostly the RWAs quoted by banks are highly uniform or not comparable or not within the same range because of the adoption of internal models. So even if the output floor would kick in, output floor would still mean there will be a 27.5% gap between the output of a standardized method and the IRB method. So this needs to be stemmed to ensure uniformity. So what they have done is they have abolished the ARB, that's the advanced IRB method, for large corporates and banks. Retailers and SMEs, like we shall see in subsequent slides or subsequent videos more about this, but still allowed with a lot of changes, peaks in and around. So basically, these are the biggest asset classes where there is a lot of variability: corporates, banks, retail, and SMEs. So a lot of tweaks have been done in these asset classes to ensure uniformity. Now let's move on. Operational risk reforms. So operational risk is another major component under Pillar 1 of Basel framework. So earlier there were so many methods: basic indicator, standardized and advanced measurement approach (AMA) for calculation of operational risk. Now all these methods have been revoked and there is just one method known as single standardized measurement approach, or SMA. So basically SMA is a sum of the business indicator, size of the operation, plus internal loss multiplier, historical loss experience. Meaning this attribute or this component is linked to the annual sales or the size of the bank, and this component, which is internal loss multiplier, is linked to the historical experience or track record of the bank in handling or in facing operational risks or operational errors. So this has kind of made it uniform, and also earlier there was very less rigor in conformance to the operational risk. Now that has been done away with by a single method or uniform method for calculation of operational risk across the globe for all jurisdictions, for all banks. This is again a game changer, but not as big as output floor or credit risk, because operational risk is still a small part or a fraction of credit risk for banks. Leverage ratio, we already saw what leverage ratios in earlier videos. Now what has happened is leverage ratio has been increased by 50% for globally systematically important banks, in other words GSIBs. Okay, so this would mean, like I said, the GSIB is a annual list published by the Financial Stability Board. So this buckets, the GSIBs under various buckets, which is about 5 buckets, based on the complexity and sophistication of their own business models. Okay, and these banks need to be safeguarded. There are a lot of additional ratios for them in the form of GSIB buffers, which has been put earlier also. So this is specifically applicable to the globally systematically important banks because they form a substantial part of the global balance sheet or the global GDP, and they need to be safeguarded well to ensure they are always stable at all point of time in the economic cycle. Okay, so what happens is, now leverage ratio has been increased by 50% for this GSIBs. So meaning you already, if you are a GSIB, you would already have to keep set aside an additional amount of capital. In addition to that, your leverage ratio also needs to be increased by 50% compared to a non-GSIB. Market risk. Though the slide does not capture the complete details, but I shall give a slight overview. So there has been a complete overall, just like how there has been a complete overall in market risk similar to credit risk and operational risk. In this case, there is something known as FRTB, Fundamental Review of the Trading Book. Basically, it advocates strict rules for trading book versus banking book boundary, meaning banks were exploiting the loopholes between the trading book and the banking book for favorable RWA treatment. So now it has drawn the line very clearly and thickly, meaning banks can no longer exploit the loophole and has categorically defined products and asset classes which can be calculated under the trading book and calculated under the banking book. If it is under the trading book, it would fall under the ambit of market risk. If it were to fall under the banking book, it will fall under the ambit of credit risk. So there is something known as new standardized approach for market risk. There was an earlier method known as VAR, value at risk, that has been done away with or retired, and there is a new method known as expected shortfall. So that has a lot of granularity and a lot of density to it in terms of calculation methodologies. So basically, the problem or the deficiency with VAR was it didn't capture the tail risk. Tail risk is a key component wherein market positions bear a lot of the brunt towards the fag end of the problem, meaning the amount of losses will swell like anything, and that will not be properly captured on the VAR method because VAR method is more of a curve method, similar to the bell curve which we follow in most of the organizations. So what has done? So that was a problem, and that came to acute deficiency during scenarios like Basel III or during the 2007-8 and the COVID-19 crisis. However, based on the observations under the 2007-8 crisis, BCBS has decided to do away with VAR and implement something known as ES, expected shortfall, which will address this concept of tail risks and illiquidity in trading, which these two concepts are very important from a perspective of market risk. Now, I've just mentioned them. In the subsequent video or the next video where there will be a detailed walkthrough, I'll explain them in detail. So key features of Basel IV. Under Pillar 3, banks must disclose their standardized versus internal model RWA for comparability. Apart from that, a lot of new templates have been introduced, meaning there will be a lot of information which needs to be presented and divulged to the general public. Okay, so this is the implementation timeline. Initially it was 2022. Thanks to COVID, it got to delay to Jan 23. Now phased adoption until Jan 28. The output floor, which is at a maximum of 72.5%, will be in 2028, but will be slowly starting from 50% in 2023. So credit risk, operational risk, leverage, market risks, where there has been major overhaul, those reforms also will be slowly adopted, because Basel IV is expected to increase the RWA for banks anywhere between 10 to 20%, meaning there will be a tantamount increase in the amount of capital set aside. Okay, the positive. So greater consistency restores credibility in RW capital ratios, reduces regulatory arbitrage. In other words, it brings everything to a level playing field, irrespective of the size or the model or the geography or the business you operate in, and very little scope for rigging, very little scope for inconsistency. So, meaning regulators, whatever RWA or capital numbers that is presented to regulators, regulators can now believe that and trust, and also have a definite sense of confidence that these ratios will be good in any kind of crisis, and there will be no weak links or no weak banks during a crisis. Okay, and challenges, especially in the European Union region, which is more addicted or more inclined to the IR internal methods, when they have to move to concepts like output floor and abolition of ARB for certain asset classes, we'll see a spurt in RWAs, which is definitely a challenge. So when you need to set aside additional capital, which will increase by 15 to 20%, meaning you will not have enough money to lend or continue or your pursue your growth plans. So meaning that will definitely take hit. Point taken. And compliance burden due to new systems for standardized method. Basically, you need to understand the regulations, infer that, then implement that, which would mean a lot of stress on hardware, software, and manpower costs, which needs to be beared by the respective banks. Okay, so this is a high level difference. Output floor, game changer under Basel IV. Credit risk, multiple internal models, standardized, dominates. IRB restricted few important asset classes like corporate and banks. AARB method, operational risk method, multiple methods. Now all have been done away with. Single method known as SMA. Market risk, old trading book rules have been abolished. Stricter rules or clear demarcation between banking book and trading book. And apart from that, VAR method has been abolished, and there is something known as expected shortfall. Leverage ratio at 3%. Now, leverage ratio should be kept higher for GSIPs. Disclosure, basic pillar 3. Now, the pillar 3 requirements are more comprehensive and expansive. That's a sneak peek about me. I hope you like this video. I shall publish another video where we shall see all these details, all these concepts in much more detail. I hope you like this video. For more such videos, share, subscribe, and like. Thank you. Good luck.